All right. Good morning, Keller Williams, Greater Metropolitan, and welcome to this week's installment of Training in 10. For those of you who don't know, haven't heard, or wondering why I'm going live, Wednesdays at 10 o'clock, we are going to have an agent or member of our leadership team pop into the Facebook group, do a quick training, just an opportunity to plug a little bit more information, another strategy, another quick tactic. Today, I'm going to talk about the opportunity, or excuse me, I'm going to talk about the opportunity that exists with the upcoming potential for a recession. So you're going to hear more and more about this over the next 10 days. I think official Q2 GDP numbers come out next week. I believe it's the 27th. We'll have official numbers. So and that's going to dictate a lot of things for the back half of the year from an economic standpoint. So first of all, let's define what a recession is. This is something that gets thrown around. Maybe in your younger days, you or throughout your life, you've heard it. Maybe you don't always understand why it is, and it's why always waiting for somebody to tell us that we're in a recession. A recession is defined as 2 consecutive quarters of gross domestic product with negative growth, right? Or shrinking, right? So all of the economic activity for the United States of America, everything you buy, everything that's made, everything that's sold, rolls into one number that is gross domestic product, or GDP, right? So if that GDP year over year is getting bigger, we're in a growing economy. If it is getting smaller, that's not a good thing. It means people are spending less, we're making less, we're earning less, we're doing less as an economy. So we want the number for healthy growth to be somewhere between 2 and 4%. If it gets too high, that means your economy is running too hot and goes off like a rocket, comes down like one. If you have no growth or low growth or negative, that is a bad thing, because that means your economy is shrinking, which means that there isn't room for more activity. So 2 consecutive quarters of negative GDP, right? That equates to a recession. So the first thing I want you to understand is that it takes 7 months, right, to call a recession, because we've seen negative GDP in the first quarter of 2022. It was down about 1.5%. We're not actually going to say that we're in a recession until the end of July, seven months into the year. But the first 6 months of the year will be negative GDP, right? So you're 6 months of run up into a recession being announced, and then you're in a recession. Now, here's the thing. We are not 100% sure that we're going to be in a recession starting next month, because we don't know the numbers yet, and there's a pretty broad spread. Some economists are saying it's probably going to be around negative 1% GDP. Others are saying plus 1%. So there's going to be a range. Now, if it comes in flat or positive, we are not operating in a recession. But some of the information that we're going to talk about is still very important, because we could see recession-like behavior. So once we get into a recession, then everybody starts behaving like we're in a recession, and that, some would say, some economists argue, that compounds the recession. Whenever there's more pressure on stock market, dividends, on production, or people start to realize, hey, this thing's going to shrink for a little while, we're going to start to cut marketing, start to cut headcount, do that sort of stuff, you can see recessionary behavior. Here's a couple things that I want you to understand as we look at what's on the horizon for us. So, of course, I'm going to go to the whiteboard. The first thing I want you to understand is that most of us, when we think about growing markets and recessions, the first thing that pops into our mind is something like this, right? Is that things go up and they come back down, and they go up and they come back down, right? We use this as an example of the real estate roller coaster. Oh, I've got 5 closings, I've got 1 closing. I've got 5 closings, I've got 1 closing. When we think about GDP this way, we're actually wrong, right? Because it doesn't go up and down, right, on one even plane. What's important to remember as we enter into an economic recession is that our economy, the stock market, home values, everything in the equation around the economy, right? So we're going to get rid of this. It actually goes like this, right? So we grow and then we recess. But when we grow out of that recession, we're growing far beyond where we ever were. So this is a very important thing, and we've all heard Eric Akbar tell us what Warren Buffett tells us, which is when other people are greedy, be fearful. When other people are fearful, be greedy. And what that means is during these times, right? Everybody's scared and thinks that the sky is falling and things will never be as good as they once were ever again. And the simple matter of the fact is that every single recession throughout history has never been permanent and has always led to a longer period of economic growth following it, right? And so what I want you to understand is you do not want to bail out on the downslope. You do not want to sell your investment properties. You do not want to sell your stocks. You do not want to do anything that pushes you away from your assets during recessionary times. Because as bad as things may ever seem, and we're going to talk about from an economic standpoint and then from a real estate standpoint, as bad as things may ever seem, right? The longest recession in the last 50 years was 18 months, right? So this falling period, the longest one was 18 months, and that was the one in 2008, the great financial crisis. In the 70s, you had the oil crisis. That was 16 months. In the 80s, you had the first of the two dips. So in early 1980s, there were two separate recessions, only a few months apart. So you had 6 months for the first of the double dip and 16 months for the second of the double dip. 8 months for the recession in the early 90s. That, if you will remember, all my political buffs, that's what got Clinton elected, which was awesome. Or not, apolitically, it's an interesting fact, right? It's about the economy, stupid. We all remember that. And then the dot-com bust in the early 2000s and 2001, that was 8 months. Now, the period of time that you are at this leveled off on the bottom where GDP is, up and down, you're out of a recession, but you're not in growth mode. That can be a similar amount of time, 6, 12, 18 months. Here's what I want you to understand. This growth period that follows, right, on average, 8 years. 8 years of economic growth following each recession, right? So the oil crisis in 1973, next recession wasn't until 1980, right? 1981 for the double dip, and then 1990 was what started the Bush Senior recession. And then our next recession wasn't until 2001, and then 8-9 for the great financial crisis, which we came out of in 2010. So now we're looking at 12 years of economic growth, right? So staying in the game is a huge priority. Here's the other thing. 5 of the last 6 recessions, interest rates have improved. I don't think that that's the expectation with this next recession. It's not a lever that we can pull since we just pulled it a couple years ago. They're calling the pandemic time period a recession. It only lasted 2 months. It was a blip. There were huge externalities there. So there's a lot of arguments as to whether or not you would count that as a recession. But a lot of things positively impact you can positively impact interest rates throughout a recession to stimulate the economy, right? So here's another thing to consider. And this is where there are opportunities with respect to us as real estate agents, but we have to put our empathy hats on when we think about this. If the economy is shrinking, if companies still intend to deliver to their bottom line and they still intend to deliver dividends to their shareholders and profitability to the street, as they say, to Wall Street, they're going to look to pull one of 2 levers to immediately adjust their expense profile. The most dynamic expenses that exist in most companies are personnel and marketing, right? Now, a lot of companies are going to cut marketing because you can cut it on a dime, right? And it's a Band-Aid that you don't have to rip off. A lot of case studies would show that that's actually not a good thing to do. You want to capture mind share. We talked a little bit about it yesterday in our sales meeting. You want to capture mind share during these times because if other people pull out of the market and you lean into the marketing, you're going to get more for your marketing. Now, here's the second thing, personnel. So if we are in a recession, and if that recession starts to manifest itself in a negative way, it's going to start to show up in layoffs. And we have to remember there are only 6 things that drive somebody's decision to buy or sell real estate. birth, death, marriage, divorce, promotion, or demotion. And so from a housing standpoint, right, and specifically in the market coming into out of the market that we were just current in, we could very quickly end up with a lot of listing inventory as individuals who got into homes in the last 36 months are suddenly faced with the prospect of having to relocate for employment or for having to downsize to maintain economic stability while they weather demotion or potentially layoff, right? And so this is, and think back to the most recent recession, which was the great financial crisis. This is, and anybody that has worked in that environment, if you were at our mastermind last week, the Shift Proof Your Business panel talked about this. This is where you earn clients for life, right? In tough economic times, people will need your help, your expertise more than ever. And so if we are there for them, we are sharp, we understand the economy, we understand the market, we understand housing, we understand what's going on with interest rates, we understand what's happening with inventory, we can be that local economist of choice, we can be that expert. But first we have to understand what's going to be driving that and who to get in relationship with or who to strengthen relationships with, right? So over the course of the next probably 36 months, the recession is going to pop up. Really want you guys to just, one, have a baseline understanding of what that is and what it means to be in a recession. Two, hang on to your assets. They will appreciate, right? Make sure that you are saving money now and editing your expenses down to lower your monthly burn rate from a capital standpoint so that you can survive and even thrive during the next 36 months. That could be that potential economic stagnation. And then finally, be ready to hit the ground running and let's crush it. If anyone wants to talk more about this, you want to get into the opportunities for stagflation next year and all that, would love to chat with you about it. But this has been your Training in 10. Be sure to tune in next week. We got another great one coming that is going to be much more practical and tactical and you could apply to your business immediately. But hopefully you know more than you did 10 minutes ago. We will see you guys soon. Have a good one.